Welcome to Morgan's Edward Street weekly wrap for the week ending Friday 22nd of June. Briefly in macro news this week, oil prices have been very choppy as ministers arrive in Vienna today for the two-day OPEC meeting to discuss global oil output, with analysts expecting a significant decision on production amid political tension between some member states. Saudi Arabia and Russia are urging OPEC to lift production after 18 months of tight output control, whilst Iran and other members have expressed opposition and have gone as far as threatening to veto the Saudi proposal. It's no doubt going to be a complex and is expected to be one of the toughest in recent memory. In other news, the Aussie dollar has steadied after seeing some renewed selling pressure midweek, buying 73.76 US cents. RBA Governor Philip Lowe delivered some dovish remarks at the ECB conference in Portugal, noting that he remains confident that Australia's inflation rate will get back to 2.5%, but said that it's just going to take us a bit of time. To try and get it back to 2.5% very quickly, it would be mainly through people borrowing more money and having high asset prices. I think that's a much bigger risk to our economy than people having surprisingly low inflation expectations. In stock-specific news, Telstra held their widely anticipated investor briefing day on Wednesday, and it would be fair to say that the information delivered was not entirely what the market was looking for. The main reason for the stock price fall was the announcement of full year 2019 EBITDA guidance of 8.7 billion to 9.4 billion, excluding 600 million of restructuring costs, which was below consensus forecasts at 10.5 billion. Other points were: one, a significant operational restructure that will see Telstra effectively split into two, with the company's hard assets such as ducts, exchanges, etc. placed in an infrastructure arm and potentially demerge at a later date. And two, plans for up to $2 billion of divestments and plans for an additional $1 billion per annum in cost out. Morgan's analyst Nick Harris has cut his dividend forecast from 22 cents per share to 17 cents per share, adopting a more conservative approach, given the restructuring costs and assumed NBN delays. Nick retains an ad recommendation, but has reduced his target price about 14% to $3.42 a share. Please note that the companies in this video are general in nature, and please speak to your Edward Street advisor if you wish to know if any of the stock recommendations suit your personal needs and objectives. I'll now pass over to Cameron for his idea of the week. Cammy?
Yeah, thanks, Brad. The stock I'm going to cover today is a new upcoming IPO named Viva Energy. Viva is one of Australia's leading integrated petroleum companies, having operated for 110 years and supplies approximately 1/4 of Australia's fuel needs. Viva supplies this through a nationwide retail network of service stations, the majority of which is Shell branded, and services commercial customers across a diverse range of industry sectors. So why do we like this company? Viva Energy has a scale whereby they've supplied over 14 billion litres of petroleum products annually over the last 3 years, sourced 41 million barrels of crude oil and 73 million barrels of refined petroleum products in 2017. Viva Energy's fuel products are supplied to consumers via a national network of 1,165 retail sites, and this shows their extensive retail network with a strong brand recognition. Viva Energy employs a capital-light operating model for its retail business and leases a large proportion of its sites from Viva Energy REIT and other third-party property owners. The company has a diversified revenue base, and its commercial and specialty businesses serving long-standing customers in the aviation, marine, transport, resources and construction sectors. Viva has a strong financial position with underlying EBITDA that has grown from 535 million in FY15 to 634 million in FY17. The company has capital efficiency with a return on capital employed of greater than 20%, with a strong balance sheet and low debt. Morgans are fortunate enough to be listed as a co-lead manager to the IPO, which is seeking to raise $2.4 to $3 billion. This will be the largest IPO since Medibank Private, creating a new ASX 100 listed company. The price hasn't yet been finalised, but will be in the range of $2.50 to $2.65 a share. This will put the stock on a PE within the 13 times price range on forecasted 19 profit figures. So start getting your bids in. Thanks, Brad.
Thanks, Cam. Next week sees the end of the financial year, which has seen the ASX 200 up about 9% for the year. Lots of stocks going ex-dividend and distributions next week, with a plethora of REITs and infrastructure stocks making it for the end of the year. Well, once again, that's it for another wrap. Please feel free to share this video with your colleagues and friends, and make sure you like the Morgans Edward Street Stockbroking Facebook page. Also subscribe to our YouTube channel below. Have a great weekend.